Okay, let's go to entry E. Okay, now entry E and F we need to discuss for a minute. Okay? When we were costing out or calculating the cost of the parts that we sold, they actually gave that number to us, didn't they? Gave it to us in a code on the invoice, right? So we knew what the cost was. And when we were dealing with artistic furniture yesterday, when we sold something, we knew what the cost was of the items we sold, correct? Now, if someone wants to take the time and tell us every time what the cost of the merchandise was, that's great. That's called specific identification. In other words, they specifically identify what the cost is of the items we sold. And it's given to us. Or we had to go out and research it and find out what it was. Okay? Now, for less expensive items, like candy bars and gallons of milk and a gallon of gasoline, for less expensive items, it's somewhat impractical for them to write down the cost of everything that was sold, right? They're not going to take the time to do that, okay? And nor do we want them to. That's very inefficient time spent. So we're going to use one of two other methods to calculate the cost of goods sold. For parts, we use specific identification. For the next one down there, which is groceries, we're going to use a method called percentage of sales method. Okay? What percentage of sales says is that we're going to figure out, on average, what our cost is as a percentage of the sales. Now, let me give you an example. Let's say that we sell shirts in our business. That's all we do is sell shirts. And that we mark up the cost of the shirts 100%. Now that means if it cost us $10 and we're going to mark it up 100%, what are we going to sell it for? $20. Or 100% of the cost, right? If we were to mark that shirt up only 50%, what would we sell it for? $15 or 50% of the cost, right? But the average markup on clothing is 100%. So let's talk about that. If we sell another shirt that cost us, another shirt cost us $15 and we mark it up 100%, how much are we going to sell it for? $30. If we get a shirt that costs us $50 and we mark it up 100%, what are we going to sell it for? $100. So everyone's got that concept, okay, right? Now, what if we sell 10 shirts that cost us $20? How much is our sales? $20 each. That means we're going to sell each of them for $40, and we sell 10 of them. How much are our sales going to be? What was our cost? $200, or half the sales, right? So our percentage, our cost as a percentage of sales, then in that case, is 50%, right? Okay. So if our sales of shirts next month are $1,000, what is our cost? $500. If the next month our sales are $5,000, what was our cost for the shirts? $2,500. So everyone got that concept? So if you can determine what percentage your cost is of the sales amounts, you can figure out what your cost is, can't you? Now it's an average. It's an estimate too. I mean, you might have a sale one month, and your markup's not 100%, but it's something less than that because you're trying to get rid of all your older stock. So your percentage could be adjusted, couldn't it? Okay? Now, where do we get that percentage? We're going to go back to Volume 1 for just a moment. Volume 1, Chapter 7, at page number 9. You'll see what's called a markup to gross profit conversion table. This is something that we've created in our books. If you can find out what the markup is in a given industry, like for instance, we talked about the fact that clothing industry, the average is what? 100%. We find 100%, now it's going to be over on the right-hand half of this table. We find 100%, look at the cost of sales percentage. What does it say? 50%. And isn't that what we were just talking about? If we sold it for $5,000, the cost of sales is 50% of that, okay, or $2,500, right? Half of that. Now let's say that it's a jewelry industry and our average markup is 1,000%. What is our percent cost of sales? 9%. So if we had $10,000 worth of sales, 9% of that is $900. We're going to estimate that our cost of that $10,000 worth of sales was $900. Do you see that? And that entry would be credited to inventory and debited to cost of sales, that $900. It is an estimate. We recognize that. But we've got to come up with some number. Okay? Now, in this business, the average markup for the groceries was 25%. So what is our cost of sales? 80%, right? That means that if our sales of groceries were $1,000, what's 80% of $1,000? $800. So we are estimating our cost of sales are $800. Okay? And our gross profit then will be the difference between what we sold it for and what it cost us, or the $200, right? Okay? Does that make sense to you? That's the percentage of sales method. Now, in order to calculate that here, we've got to, first of all, find out how much our total grocery sales are. So where are we going to find our grocery sales? I'm sorry, say that again. Cash receipts and sales journal. So let's go look at that for a moment. And how much did we have from the cash receipts and sales journal in grocery sales? How much? 11,300, right? So that's, is everyone agreeing with that? 11,300. Now, we also had some grocery sales in the parts and service sales journal. Okay? So we had 11,300 from the cash receipts and sales journal. How much did we have from the parts and service sales journal for groceries? Remember, we let some of our customers buy groceries and put it on account? How much? $124. So we need to add both of those together to get our total sales. So what's our total sales? $11,424, right? Okay? 11,424. Now that's what our sales were, and we're going to estimate that our cost of sales is 80% of our sales, because our average markup was at 25%, so it converted to 80%. So what is 80% of $11,424? 9,000 how much? Okay, $9,139. Let me write that down. 80% equals $9,139.20. Is that right? Okay. So we need to make an entry for $91.39.20. What's that entry going to look like? Very good. Debit cost of sales groceries, which is account what? Account 610. We're going to debit account 610, cost of sales groceries. And what are we going to credit? Groceries inventory. Good. Which is account number 230. So we're going to credit account number 230, groceries inventory, for $9,139.20. And we're going to debit account number 610, cost of sales groceries, for $9,139.20. Okay? Now, what would be the alternative? If we use specific identification, it would indicate that every time we sell a candy bar, they're telling us what the cost is, and every time we sell a candy bar, we're actually going to show the cost of sales for that individual entry. Okay? Every single time. Well, that would be a lot of work, frankly. A lot of work for everybody. So it's not practical. So with smaller, less expensive items, we're going to use either this percentage of sales method or the one that we're going to show you right now for gasoline. So let's talk about that. The second method, unless there are any questions on this one. Okay? The second method that we're going to use here is going to be what we call specs. Okay? Now let me define what that means. It is a calculation. It starts with the starting inventory. To the starting inventory, we add purchases. From that, we subtract the ending inventory. And that equals cost of sales. Now, where it gets its name from is it's an acronym. SPECS. Okay? Specs. Now, let's just define this a little bit, kind of understand it, how this works out. If we started out, if we happen to be a marker salesman, okay? Not a high demand business, but it works, okay? If we happen to be a marker salesman and each marker cost us $1 a piece to buy, and then we sold it for maybe $1.50, I don't know, okay? But it cost us $1 a piece to buy. And at the beginning of the month, we had 2 markers in our inventory. What was our starting inventory? $2, okay? So we're going to put that down here. Now, during the month, in order to provide for our customers' needs and so forth, we had to buy 6 more markers, okay? So between what we started with and what we bought during the month, how many do we have? 8. Well, we need to put the purchases down. We bought 6 more markers at $1 a piece, so that's $6. So we had, during the month, $8 worth of markers, right? Now, at the end of the month, all we had was 1 marker. That was it. Just 1 marker, okay? So our ending inventory was $1. Does everybody see that? So our cost of sales was 2 plus 6, or $8, less the $1 that we still had at the end, and so that meant our cost of sales was $7. Because where did those 7 go? We sold them, okay? So it's a very logical calculation. It's the same one the IRS uses in their tabulations. I mean, it's really the preferred method. The problem is you have to have information in order to do it. Somebody has to take a physical count every month to give you the starting and ending inventory, don't they? Now, the starting inventory this month was just the same as the ending inventory last month. So that was a given. If they did the ending inventory, we got the starting inventory. But then at the end of this month, they're going to have to do an ending inventory again. So they're going to go out and count all the stuff and multiply it times the cost to come up with it. Some businesses can do that very easily. Some businesses can't. Imagine taking a inventory for a hardware store. You know, it's going to take a while. How often do you think Smith's or Albertsons takes an inventory? I would have thought that too. But we actually have had some managers take this class, and they tell us it's quarterly, which surprised me. I expected it to be annually, and a lot of grocery stores are annually, yeah.
That's something that they outsource to inventory specialists.
That's right. They actually have companies that they hire in, or sometimes it's church groups or something that they come in and for fundraising. They'll do it. So, but they do it quarterly, which surprised me. But in any event, in between there, they still do financial statements, and so between those 2 quarterly inventories, they don't have in the months between there, they don't have an ending inventory because they only do it once a quarter. So they cannot use specs method to do their cost of goods sold. So what do you think they do in the other 2 months of the quarter when they don't have an ending inventory? Percentage of sales, okay? So in the other 2 months, they're going to get a percentage and enter it in. It's only going to be on those months where they do an inventory that they actually use the specs method to calculate inventory. Does that make sense? Okay. Now, gasoline is very easy to inventory. You ever seen anyone do it? They got a long stick. You've probably seen it and maybe not even known it. You know what they do? They got a long stick that they stick down into the tanks under the ground, and then they pull it up and they look at what the level of the gasoline is based on where it's wet on the stick. and it will show how many inches they have. And then they have a conversion chart inside that says if it's 18 inches, then this is how many gallons for that size of tank you'll have. Okay? They do that every night. Now, the reason why they do that isn't necessarily to provide us accountants with a lot of good information. It's because they got to know how much gasoline's in there to know if they need to order gasoline for the next day. Okay? But they're doing that every night. So can we use the specs method for gasoline? What's that? Yeah, we can, can't we? Because we got a starting inventory, right? And we got an ending inventory. So, and where do we get our purchases from? What's that? With the cash disbursements and purchase journal. Okay? Our purchase of gasoline, right? Let's go through and do this with Barry's Gas and Groceries on the gasoline. Now, he started out with dry tanks. The tanks were empty. So what was his starting inventory at the beginning of the month? 0. Now, during the month, how much gasoline did he purchase? What was the cost of the gasoline he purchased? Where do we find that? Yeah, it's in the cash disbursements journal. It's the total of the gasoline inventory purchases, which were $24,550, right? Someone stuck the tanks the night of the last night of the month on October 31st, and they found out how many gallons they had. We multiplied that times the cost to come up with a ending inventory, and the ending inventory, the cost of the gallons that were still in the tanks at the end of the month was $4,650. Okay, now let's go through this. Empty tanks, no inventory. We bought $24,000 worth of gas during the month. Okay, at the end of the month, we still had $4,650 worth of gas in those tanks. So what was our cost of sales? $19,900 worth of gas. Is everybody with me on that? Okay. Very good. Debit count 600, gasoline costs for $19,900. Credit account 231, gasoline inventory for $19,900. Okay? Now, those are all the general journal entries. In fact, we have now recorded all the entries for Barry's Gas and Groceries.